Hello, everybody. Welcome to the Your Bread and Butter podcast. I'm Ryan Cummings.
And I'm Andrew Beaudry. Today we're going to be looking at credit scores. Improve your credit score and improve your life.
Stay tuned.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Private Financial Design LLC are not affiliated.
Bread and butter.
Welcome back. Today we're discussing credit scores, how to improve them, how they relate to your life, your mental health, as well as your financial health, and all the tips and tricks to navigate that landscape.
Yeah, we want you to be able to engage with us today at a level that maybe you've not engaged before. A lot of people look at their credit or their debt and those issues in a very shameful way, but it doesn't have to be that way. Let's talk about that.
Yeah, it really doesn't. I mean, I think some people view building up debt as a failure, if you will. Maybe they're the only ones suffering from that problem, when in reality, having a scenario where you got a stack of bills in the mail, credit card statements, making minimum payments, and maybe even having past due payments, it's something that a lot of Americans struggle with. It's not just an isolated issue. It's actually a growing problem across our country.
And then you feel trapped. You feel like, oh my goodness, the bill is never going anywhere. And it's not a shameful thing. It's just something that's part of unfortunately, our economic and social culture. And so these numbers do show broadly how Americans are facing similar battles. So we have to talk a little bit about the big picture and how you fit into it, into your world.
When we look at the U.S. as a whole, household debt, it's pretty staggering. We're looking at recent reports showing over $18 trillion in total debt amongst U.S. households. And kind of within that debt, we have credit cards, the revolving debts, the things that are you kind of maybe would categorize as the quote unquote bad debts, the higher interest rate debt and whatnot. That accounts for more than 1.2 trillion of that 18 trillion in total debt.
That's almost 10% of the whole amount of debt.
It is. Yeah, it is not a great number, and because at the end of the day, maybe this is a great preference to start with. Debt's not necessarily a bad thing.
No,
a lot of people are debt averse, others are not, but when it comes down to debt, it could be a tool if you leverage it properly, especially with things like mortgages. The whole creation of debt in the first place is a way to give the regular person, the average American, access to certain goods or services that maybe they wouldn't have been able to afford or have had access to otherwise, the big one being homes and cars.
And unfortunately, the part that really hurts the most when people don't use the debt properly, the revolving debt, which is really in credit cards, it's risen sharply. And the rising debt has real world consequences. When you're only making minimum payments, it just compounds the interest, and it's just chipping away at, or actually adding to, instead of chipping away at your debt, it's adding to your debt. And almost 11%, 10.75% of all active credit card users are just making the minimum due, which is right now the highest rate in our recorded history. So the per household and per person debt numbers are pretty high.
Yeah, we're talking about $6,000 in credit card debt per household, the average. That's data from the Federal Reserve. There are some other sources, actually, as I was kind of researching some of this, that claim that average is actually upwards of $10,000 per household of average credit card debt, which, again, is in that bad debt category because it's high interest, it's not tax deductible, it's easy to spend on, it's easy to accumulate. And, if you have too high a credit card debt, you can kind of just feel like sometimes that you're just treading water as far as rather than paying down your debt.
And many Americans have as many as 4 credit cards per person. So part of what we're trying to do today is to try to help show each of our listeners in some way or some fashion a way to handle this. Now, obviously, if you don't carry any debt, this may not be a good session for you. However, you might have children, or you might have grandchildren, or you might have other relatives or friends that could use and benefit, because sometimes, relatives don't listen to each other because, it's all relative as to whether or not you're going to listen. So credit score distribution is and risk levels is pretty pretty clear as to where the issues are.
It is. And with credit scores in particular, which is the big topic of today's podcast, it's not always tied to exactly just how much debt you have. Because like we were just talking about, there's some pretty staggering debt numbers in our country. But when you actually look at a distribution of credit scores, we've got about 71% of consumers that actually have good or better credit. So we break those down into 5 categories: poor, fair, good, very good, and exceptional. These scores range anywhere from 300 in the poor category all the way up to exceptional being 800 plus. So you could be anywhere in that range. But I mean, if you're in the 600s, kind of in the mid 600s or higher, you're in that good to exceptional category, those top 3. And that is where the most of Americans lie, that 72% of consumers. So it's not necessarily the high credit card debt doesn't always mean terrible credit scores. Sometimes it's the other habits that we will talk about that come along with high credit card debt that actually drive down your credit score.
And we're hoping that in sharing this, it motivates you, so that you don't hide from your feelings on it. If people just hide from their emotions when it comes to their money, you'll hear us say it a lot. Emotions and money make a terrible partnership, and it's true even with accruing debt. So the real consequences, there's a human consequence to this, and poor credit scores really do give you have a problem. You have a problem. Access and the cost. When you have poor credit or no credit, it really effectively excludes you from getting more favorable loans, mortgages, leasing terms. You pay more interest. You have higher fees, and even facing rejection.
Yeah, it can create a lot of those hurdles when trying to take on new debt. If you're looking to buy a home or buy a car, those things that a lot of times debt is necessary to use. But there's also the mental side of it too, the stress. We'll look at some metrics in a second, but when it comes to stress, finances are the leading cause of stress among Americans. When you survey them, most Americans will say finances are the number one cause of their stress, and something like bad credit can just kind of compound that effect and make other future financial decisions even more difficult when you want to make those other financial moves down the line.
Yeah, I think people forget or try to forget how much stress bad finances bring into their life when they can't qualify for a car loan or qualify for the best mortgage rate. And there are certain blind spots that come up. Let's talk a little bit about the blind spots that happen here.
Yeah, big one is just awareness.
Yeah.
27% of U.S. adults don't check their credit report annually, which is usually a good benchmark. Now, I will say, from time to time, I may be guilty of that myself, and maybe to check it every single year, but every other year, or at the end of the day, if you're someone who's got a good credit score, you're monitoring your spending, you're checking other things like bank statements, maybe you don't necessarily need to check it every single year, but you should be checking it periodically just to make sure there's no fraud on there, because sometimes that can be where you discover maybe something subtle that's been going on using your information.
Or even mistakes, errors.
Yes.
There's been times when I've had to contact the credit bureau to clarify something and get something removed because it was done in error. It was the loan had been paid off years ago, but it was showing still outstanding. Well, it's not there because it was already paid off.
To that
so you
point,
got to clear that up.
Right, and to that point, you don't want to find that error when you're maybe filling out an application for a mortgage. You want to find that out ahead of time.
Exactly.
Get that cleaned up, because that could be an error that maybe causes you to actually get rejected on your mortgage, even if it wasn't correct. If you can't get it cleaned up in time and corrected with the credit reporting agencies, a bank might just simply deny you and could delay your home process. Maybe even you end up losing out on that home altogether.
You have to be persistent too with the credit card companies and the people that are involved in that. And I would say this too, that when you're going through something like this, this is the real world in which we all live in. So you don't want to just put your head in the sand here. Get yourself a credit card that actually provides you free credit scores. A lot of the credit card companies out there, Citibank is one of them, Chase is another one of them, the major card players in here, you can get your credit score for free. And you can see it, and if there's a change in it, you get notified. Or you can pay for one of those higher end credit monitoring services, which in today's world, it's not a bad thing to have, where for $12, $10 a month or something like that, you can actually have a real-time tracking on any dark web stuff, people trying to attack your credit, or even just addressing your own credit needs. So find a way to at least get notified on it on a regular basis. So most people, even though they don't understand this, particularly in lower income communities, it is your credit record is vital to protect for all things.
It is. If you have low credit and you're struggling with maybe applying for a loan, why calculus professors are actually a great friend to have when you're applying for credit.
Calculus professors?
Calculus professors.
Why
yes.
is that?
Because they're always willing to co-sign your loan. That's a little math joke.
Well, you like that, right? I like that one a lot. Well, you know why it's really important, though, to actually have a significant other when you start applying for credit?
I don't know why.
It's because you want somebody who can sign if I can't. Significant. Okay, got it.
Okay, I got it.
I had to explain it. Yeah. Not a good dad joke. Anyway, moving on. But the stress levels, that's what this graph is showing, the stress levels by the debt burden. I mean, look at that. These numbers.
There's a peak that happens early on. I think it's, you could see a big jump from people who have little or no debt to as soon as you start to accumulate meaningful debt, there's this big spike. And we were talking about earlier, causing stress for Americans. And as we kind of continue to see it on this graph, there's actually what we're looking like as you would think the more debt you have, the more stressed you are. But there's a little bit of a plateau effect.
It is. Particularly if you're in business, you're a business person, you're used to taking on a little bit more of a burden on the debt level as you're expanding your company or doing whatever you're doing, and so you're comfortable with that because you're building your business as you go through. But for the average consumer to take on more debt, that's a tough one. And I know in working with some of our older clients who've been debt free for a number of years, when they get ready to go, buy their next home, sometimes it's a real struggle to go be like, oh, I'm going to have to take on a mortgage. I haven't had a mortgage in 20 years, and now I'm going to have to take on a mortgage for a little while until I can, figure out how to pay it off in the right way. And that can be a real emotional struggle. But in order to get that home built, rather than lose thousands and thousands of dollars taking it out of their IRA, well, they're going to have to use a mortgage, which they haven't had in 20, 25 years. So
yeah, it's just sometimes just a mental hurdle that people have to try to overcome. And yeah, you made a good point. I didn't even think of that. I'd be curious to see how many of the very high debt category are like business owners and individuals that
absolutely
are using maybe what we call more of the good debt category that they accumulate, a lot big chunks of debt, but it's secured by, a revenue producing asset like a business or something like that.
No, we can't go through and talk about all the good debt today. We're really talking about how to improve that credit score. So as we look at this, though, you got to realize this is how your credit score is built.
Yes. Before we can even get into improving it, you want to understand the pieces of it. And so the biggest portion of any credit score, 35%, you can see it on this chart, is your payment history. To put it simply, it's just making on-time payments. Now, actually, to maybe even be more specific, in my research of these, of a credit score, it's not so much making on-time payments, so maybe I misspoke there. It's actually more of not missing any payments.
Right.
So a little bit of a myth in that category is if you make, all these payments on time, it's better for your credit score. It's actually not. As long as whether you have one debt payment or 10, now there are some other categories that different debts will affect, but at least this category, it's just don't have any missed months on your history. So when the reporting agencies look back at your history, if every month just has a green next to it where you made all your payments, you didn't miss any, you're maximizing this biggest category.
Right. So if you ever get a credit report and you look at it, you're going to see that it'll have the months laid out over the last 18 months, and it'll be, yes for yes, payment made. Now, if it's already been paid off, then there's not going to be anything there. But payment history is important. And even though this isn't in the graph, people who are only able to make a minimum payment, you're still winning by making your payment on time, not missing. However, I will say that not only should you be making a minimum payment, but if you really want to improve your credit score, if you look at the interest that's being charged at the bottom in your credit card, plus your minimum payment, that actually gives you a little bit of a plus in the credit score world. So just so you're out there, if you've got a minimum payment, it's $100, and the interest that month was $97, you should be making at least a $197 payment if it's possible to do it. But make it on time.
And making those extra payments kind of leads right into the next biggest section is your credit utilization, or also called your credit utilization ratio. That's just simply the amount of credit you're using divided by your available credit. So for example, you got a $10,000 credit card, your balance is $2,000, you're at a 20% utilization ratio. So we'll talk more about how to improve that section in the next couple slides, but that's at least what makes up that next biggest piece. And trying to keep that low, making those extra payments, is better for this portion of your credit, trying to keep your ratio at a lower percentage.
And the next one that's up to bat here is the length of your credit history. You know, if you have a credit card, like I have a credit card I had since I was 18 years old. So since I'm 118 now, I've had it for 100 years. But it's good to have credit cards on there that, are a longer history. However, if you're really not using the card and it's something that's just sitting there, it also can affect your score negatively by having too many credit cards open and not using them.
Right. And that is where we get to actually the new credit section, is opening up too many cards. There's two different types of, when you typically open any sort of new debt, there's two different types of credit pulls that you can have on your credit. There's a soft inquiry and a hard inquiry. Soft inquiries are just when you check your credit for informational purposes.
Yeah.
You can do that 1,000,000 times. There's no effect to your credit. Hard inquiries is anytime you fill out an application for taking on new debt, that counts as a new hard inquiry. And if you have too many hard inquiries into your credit, that can actually, like you said, decrease your credit score. So if you're opening all these credit cards one after another, and you have too many in a short period of time, you're looking at drawing down. Yeah, it's a smaller portion of your credit, but it still will draw it down nonetheless.
Correct. And then your credit mix is important.
Variety.
Variety, exactly.
Yeah.
How much is it? Car loan, credit card, fixed payments, loan installments, equity line of credit. The type of mix that you have in your personal credit history has some balance that has added to the score. 5
different pieces of debt. A car, a home, a credit card, a student loan, a personal loan is better than 5 credit cards, is to put it simply. Having variety is a better mix.
Exactly.
So now that we talked a little bit about the actual credit score itself, let's talk more about what can we actually do to improve those different pieces of that pie that we were just looking at.
All right. The first quick win that you can do right now, we already talked about it, never miss a payment. And the best way to do this is to set up an auto payment for at least the minimum on every account so that it automatically comes out of that bank account.
Yes,
automatically.
That's key. I mean, I think that can't be spoken to enough. Is just like if your vendor that you're using offers auto pay, then you don't have to worry about it.
Do it.
Right? You're not signing up for, you're not having to worry about paying that on whatever due date it is each and every month.
Yep. And then what you do there as well in your credit utilization, aim for about just under 30% overall and per card. Under 10% is great. So there's some easy tactics that people can follow to do this.
Yeah. I mean, just the credit utilization ratio, and that's, I think, kind of the key here. It's reported possibly on very possibly, actually in a lot of cases it is, reported on a different day than a lot of your due dates on your credit cards.
Right.
So sometimes people just wait till their due date to pay off their credit card. Well, your due date could be the 15th, but your credit card might report your balance for utilization purposes on the 1st. And so if you don't pay it off mid-cycle, you might be reporting a higher utilization mid-month, even if you pay your credit card off every single month. It all depends on when it's actually reported to the credit reporting agencies. So making those mid-cycle payments can help keep your balance lower, keep your utilization lower. Like we were talking about, below 30 is good, below 10 is even better. The lower is the better when it comes to this category. Making those payments in the middle of the statement can help with that.
And sometimes when you get your credit card statement, you might get an email or you might get a notice with it saying, hey, look you had an $8,000 credit line, but we're going to increase you to $12,000 if you want to do that. You take it.
Yeah.
Because it expands your utilization capabilities. Not that you have to use it, and never look at it like it's a checking account, because it ain't. It's somebody else's money. It's going to charge you for it. But you want to make sure, though, that if you can get it without having to do a hard pull, take it. There's nothing wrong with that.
Also, any small balances, paying those off, trying to make sure that, again, you're bringing down your ratio, getting those balances closer to zero, because contrary to popular belief, zero is not bad to have as far as your credit score. I know there's actually we'll talk more about the myths in the next slide, but, going over having some balance, some people say, and There is some truth to that, and that some balance is slightly better, but it's almost a negligible difference. And so paying off little cards, lowering your overall ratio, and then ultimately fixing errors and making sure, again, we were talking about if there's any disputes on your credit report, missed payments potentially, balance limits or whatnot, balance errors as far as how much you had charged on your account, all those things, making sure they're correct can help improve your credit score here.
Now, the next level here is the medium-term builders. It's, the next 3 to 6 months. Now, I will say this. We do live in a society that likes quick fixes. We like the Hallmark movies because they have a sweet ending most of the time. I mean, we look for quick things. Well, if you've had a long history of a bad credit score, it's not going to happen overnight.
It's not.
But if you're looking to I want to buy a house over the next couple years, or I want to expand on this or that in my personal life, you really got to start now. And it's just like losing weight and training and all of those things. It's going to take time. So first of all, attack the revolving debt first. Use a debt avalanche. Take the highest interest rate charges first, and then get after it. Pay that down. Get the interest paid. Get it down.
Yes, I'm a proponent. I'm a fan of that strategy. If you follow someone like Dave Ramsey, he advocates what's called the snowball method, which is lowest balance first. He plays to, I think, the emotional state of Americans and how little wins are good. But at the end of the day, if you want to pay off all your debt, not just one debt, but all your debt, the fastest possible, it's paying off the highest interest first.
That's because the interest charges on the higher ones, if you got a card that's, at 18% interest, and then you got another one that's at 26%, which would be like your Home Depot or Tractor Supply. I mean, you're going to have these big, huge credit card debt that's interest is just killing you.
Right.
So yeah, you might have a smaller debt on the 18%, but you want to pay down that higher one first. Now, again, Dave, nothing against Dave Ramsey, like Dave Ramsey. He's a nice guy, I get all that.
Maybe if you are the person that does need that small win, I mean, there is some merit to that. If it'll help keep you motivated to see that small balance paid off, paying off debt is better than not paying off debt.
But if you're looking at trying to save money, you pay off the highest debt first.
Exactly.
Now, the next one is the goodwill and the negotiation on past late, dues or collections. And after you can request a goodwill adjustment for a one-off slip-up for collections, and some agencies will agree to delete history, get it in writing. They might delete that bad history if you make a payment and settle it out. So this is a negotiation technique.
Yeah, that can help improve your score too. And on top of that, adding yourself as an authorized user. This is something you have to have someone that you trust, or actually really someone that trusts you is the more important piece in the strategy. But if you're, say, a young individual, you're getting started, you're maybe just graduated high school, really don't have any credit, you're just graduated college, trying to build your credit. If you can get added as a trusted person, an authorized user on someone else's credit card that's got on-time payments, got a low utilization and everything, well, that can help improve your credit score just by being added to their credit card. Now, again, they got to trust you, because if you go out and start spending up their balance, well, I'm sure they're not going to be happy for doing you that favor. But at the same time, assuming you have that good relationship with this person, it can be for parents listening, it could be a strategy to help improve your kid's credit.
Yeah. So when people are talking about their credit, the interesting part for every person is that they have somebody normally in their life that does have an understanding about money. Never be afraid to learn and get mentored by the people around you that do handle their money well. You may not agree with how they do it, but there's something there that they've learned that you can take on into your own process.
Kind of that knowledge through osmosis.
Exactly.
Being in proximity to those people that have those good practices.
And they, it's just like, I walked in on my friend one time and he was just sitting on his wallet, just sitting in. I said, "What are you doing? Why are you sitting on your wallet?" He goes, "Well, I'm trying to keep my credit score low." I'm like, okay. So anyway, that was a physical representation of how some people feel. If I just don't spend money, that'll help my credit score.
Right.
That's not how it works. You've got to find a way to work with people who do know how to spend money and how to handle it. That will help. Let's talk about our next one here.
Yeah, and a few other tips for those young people trying to build credit can use things like secured cards or credit builder loans. Secured card is where you, for example, will just pay the bank $500. You essentially give them the balance of your credit card, and then you essentially use that credit card with a $500 limit to pay your bills 3 months, 6 months. That way the bank can just see, can you manage a credit limit appropriately, and actually can help build your credit score if you're someone who doesn't qualify for a traditional credit card. I actually used one of those for my first credit card. I had a secured card back when I think it was 18. I got that card right away and had to front $500, but it was a way to begin building credit.
When I was 18, my first credit card was actually JCPenney's, and it was my freshman year of college. And I had just turned 18 a couple weeks before I started school, so I was eligible for credit card and went to JCPenney. They gave me one. So immediately I went out and I bought all of this exercise equipment, punching bags, some gloves, some stuff, because I used to box and all that. And about a month later, when the bill came due, I'm like, I can't afford to pay for this, so I went and returned all of it.
At least you had the good second step. I feel like the first half of that, a lot of people can sympathize with, and then they kind of go to, well, maybe I'll just pay it later rather than fixing the problem.
I looked at the credit card interest rate, and it was like 21%. And I'm like, 21%? That means, oh my goodness, no, I can't afford this.
Yes, well, it's a good realization moment that you had there. And then the last piece for those young individuals is rent and utility reporting. A lot of those automatically now these days, you have a utility bill in your name. It's something that in many cases, not every, but in many cases, counts towards your credit score.
Also, too, student loans weren't part of a credit history for a while, and then now they're back.
Yeah.
So, if you're in college and you're taking out your student loans, taking all of the advice we just laid out, they do weigh in on a credit score, and it is important to have a credit rating. In fact, a lot of times we counsel our folks who have children going to college, definitely not just for sweat equity purposes, but have them take a loan.
Yeah.
So that way they get a credit history started in their name, and then obviously, they can help them pay for it, but at least it gets them on the credit train.
It does. So these things all take time. The last category we have here are the long-term habits, the long-term fixes. So, for example, we talked about credit length of history. Try to keep old accounts open. If you've got a credit card that you've had around for a long time, don't close it, because what that does is that eliminates that history off of your credit score. So if that was a card you had open for 15 years, even if you don't use it, try to use it once in a while. Try to keep it open. Yes, even closing shorter cards might negatively impact your credit score, but if you have those long ones still open, it's actually not a bad idea to close maybe some younger credit cards,
a gasoline credit card from Mobil or Shell or something like that, or Citgo, whatever. I mean, those cards, you don't really need those cards anymore. There might be some benefits to it, but they're not. It's negligible effect. Your credit card balance on that or credit card limit on a card like that might be $1,000 or $2,000 for those old gasoline cards. But don't need them for the most part. Though you have an old account, you keep it open. I mean, that's a really, really good thing. And next thing is you want to limit those hard inquiries, meaning you only want to apply for credit and fill out applications when you really need to do it, when you're shopping for a mortgage or you're looking to buy a car. These are really hard credit pulls that they're going to look at. And you do it in a window where, the inquiries count, simply just as one, because it's all in the same time frame. So
they do that a lot with like mortgages. People are house hunting.
Yeah.
If you get a couple different banks you do a hard inquiry with, well, the credit agencies that's a common practice with mortgage hunting, and you'll count those all as one.
Better to do it all in the same month than it is once a month for 12 months. It doesn't work that way.
And then like we were talking about earlier, having a mix helps. So not just 5 credit cards, try to have some different debts mixed in there. And then just simply, as we keep reiterating here, monitor your credit. Try to protect it. Make sure you have, any inaccuracies fixed. If there's a sign of fraud, you freeze your credit. So, we even had people in our very office that have had to do that, of noticing fraud and freeze their credit for certain periods of time to avoid people opening new accounts in their name.
I will say this, that, there are some credit services out there that are really, really helpful. And I use one through Costco's program. It's not a plug for them as much as it is that they're they're very aware, and I not only get my monthly report, but if there's anything new that comes up, some kind of credit history or something was opened or something and it's not mine, I go in there and I can just freeze that credit and just shut it right down, so nobody's going to get anything.
It's an important tool to have.
It is
to help
very
keep your
much.
credit safe. So as we come up to the last couple tips and tricks here, a couple quick myths that we do want to try to point out and dispel. One of those is carrying a balance to have to build credit, and that's not necessarily the case. You can have, that goes back to that credit utilization we were talking about. 0 is good, lower is better. Now there is, I kind of alluded to this before, I want to hone in on it here. There is a thread of truth to that, in that 1 or 2% utilization is slightly better than 0. But we're talking slightly.
Slightly.
If you're stressing about trying to hold a small balance on your credit card just to get that 1 or 2% utilization, rather than just paying it off and having a 0% utilization, you're splitting hairs, you're giving yourself undue stress like we talked about at the start, and it's not necessary. 0 is still very good. 0 balance still does good for your credit score.
Yeah.
So, I think it's something to pay attention to.
Yeah. 0 balance does not really hurt your credit score.
Right.
So here's a weekly checklist you can go through. Number 1, auto pay on every one of your credit accounts to make sure it gets done in a timely manner.
Yes, and then also those mid-cycle card payments. So paying mid-month, don't just wait till the due date. That can help improve your credit as well.
Especially with those that are high utilization, where you do have a larger amount on it. So it does do that. And then check your reported balances that are right at your targets or under your targets before the statements close. Make sure you're getting that payment in a little bit earlier.
Yes, and then finally, just stressing it one more time here, review your credit report. Monitor it, fix those errors, try to avoid too many new inquiries, et cetera, to overall keep a strong and healthy credit. And maybe the last thing I'll even add to it is, don't get stressed out. I see this all the time even with some of our clients. If your credit drops a little bit, if you're doing something like you're going to do a hard inquiry and that makes your credit drop, your credit drops 25 points, but you're not really looking at taking on any new debt anytime soon, don't worry about it.
Yeah.
It'll recover in a few months.
Yeah.
A 25-point drop can be back to where it was in 2-3 months' time. Like, if you're not looking at taking on new debt anytime soon, it's not a big deal. If your credit takes a little bit of a dip, if you closed out that old account or did this or did that, it's not the end of the world.
And the same thing's true in anything in life. When people are trying to change the way that they eat, when people are trying to change the way that they exercise, you want to it's a gradual process. The idea of, and we have it nowadays, of taking a pill or a shot and you just becoming and transforming this new person. That can be something, but you can't just live your whole life that way. So this is a gradual process. It's not going to be an overnight thing. And you have certain things you can do along in the short term, midterm, and then the longer term. So just take that first step. Check your credit report today. Make a purposeful plan to get your credit line in a better place. So we're glad that you listened to us today, and we hope that this helps you and give you some footing to move forward in improving your credit scores and improving your life. And remember, live today for the tomorrow that's in your heart.
Because you'll never have more time to invest for tomorrow than you do today.
Thank you for listening.
Bread and butter.